All right, today we're pulling back the curtain on the corporate world to figure out the two biggest money questions that every single company has to answer. This is where the major decisions get made. Let's get right into it. So, just imagine this. A company has an amazing year. It's now sitting on $1 billion pile of cash. What's the next play? Do they go out and buy a competitor, build a shiny new factory, or maybe just hand it all back to the owners? This isn't just some textbook question. It's the real high-stakes dilemma that every successful business has to solve.
And really, it all boils down to two fundamental questions. First, when we need money to grow, where do we get it from? And second, when we actually make money, what in the world do we do with the profits? The answers to these two questions literally define the future of the entire business.
Okay, so let's tackle that first big question. How do you pay for stuff? When a company wants to get bigger, build new things, or expand, it needs cash. It needs capital. The specific way it chooses to raise that money is what we call its capital structure.
So what is capital structure? Well, at its core, it's just the mix of borrowed money, that's your debt, and owner's money, that's the equity. The ratio between these two, that's a super important number called gearing. You can think of it like a financial leverage dial that the company can turn up or down.
To make this feel a bit more real, let's dream up a hypothetical business. We'll call it Company X. It's a property company. We're going to see how cranking that gearing dial up or down completely changes the game when it comes to risk and, of course, potential reward for the owners. Now, look at this. In both scenarios, the owners put in the exact same amount of their own money, £2 million. But in scenario 2, the company borrows twice as much debt. This lets them control a much bigger portfolio of assets, £8 million worth. More assets could mean more profit, but it also means a lot more risk. So just how much more risk are we talking about? Well, in that first low gearing scenario, property values would have to absolutely crash by a full 50% before the owner's initial £2 million investment is totally wiped out. That's a pretty comfortable safety net. But what about the high gearing scenario? Check this out. It only takes a 29% drop in property values to send the company into bankruptcy. This really shows you the double-edged sword of debt, right? It juices your returns when things are good, but it absolutely crushes you when things go south.
So you have to be asking, if debt is so dangerous, why do companies use it so much? The answer is incredibly simple: taxes. You see, the interest a company pays on its loans is tax deductible. That means the government is basically giving companies a discount for borrowing money. It's a really powerful reason to take on more debt.
Okay, so we've got the tax advantage of debt down. Now let's see how this actually plays out in a real-world decision. We're going to use another example company, let's call it Wrong Turn Ltd., to watch a head-to-head showdown, financing a big new project with debt versus equity. So here's the deal with Wrong Turn Ltd. right now. They're making a decent profit, and their earnings per share, or EPS, is 25 pence. They found this great new project, but it's going to cost them £5 million to get it off the ground. So they've got a massive choice to make. The board gets together in the conference room. Option 1, go to the bank and borrow the $5 million. Option 2, create 2.5 million new shares and sell them to investors to raise the cash. These are two totally different paths, so which one is better? Let's follow the money. Okay, if they go with debt, the new project boosts their profits. But of course they have to pay more in interest. But thanks to that tax shield we talked about, the profit after tax comes out to £420,000. And, this is key, earnings per share jumps from 25p all the way up to 30p. The existing owners are now earning more for every share they own. Now, what happens if they issue new shares instead? Well, the profit after tax looks way higher, almost double, because there's no new interest to pay. But, and this is a huge but, that profit is now split among way more shares. This is called dilution, and it causes the earnings per share to actually drop to under 20p. So there you have it, the big trade-off. By choosing debt, the company saved £150,000 in taxes and made its original shareholders better off, at least on a per-share basis. But it also doubled the company's debt, making it way more fragile if that new project doesn't go exactly as planned. So that covers how companies get money. But what about that second massive question? Once a company is actually successful and profitable, what should it do with all that cash it's making? This brings us to the really fascinating world of dividend policy. At its heart, dividend policy is a very simple choice. a fork in the road. Does the company hold on to the profits and plow them back into the business to fuel even more growth? Or does it hand that cash back to its rightful owners, the shareholders, as a reward for investing in the first place?
And you know what? This decision isn't made in a vacuum. Managers are juggling a whole bunch of factors. What does the stock market expect them to do? Do they physically have the cash on hand to pay out? What are the tax hits for their shareholders? And maybe the biggest question of all, do we, the company, have better ideas for this money than our shareholders would? And there are two main ways to keep that cash back. The classic way is a cash dividend, a direct payment right into your account. Simple, clean. The other really popular method is a share buyback. This is where the company uses its cash to buy its own stock right off the market, reducing the total number of shares out there. This usually gives the stock price a nice little boost and can be a bit more tax-friendly for investors.
Okay, so we've looked at the two big questions separately, but the most important thing to get is that they aren't separate at all. They are completely tied together in what is really a great balancing act. This leads us straight to something called the pecking order theory. The idea is that managers know way more about a company's real situation than outsiders do, so their choices send these powerful signals. Using your own profits to grow is a huge sign of strength. Taking on debt shows you're confident, but issuing new stock, that can sometimes signal that managers think the share price is too high, so it's often the last resort. For an investor, this pecking order is like a secret roadmap into what management is really thinking. So in the end, none of these decisions are set in stone. They're part of a continuous living strategy. A company is always tweaking its mix of debt and equity, and always deciding whether to reinvest its profits or hand them back. It's all part of that constant effort to balance risk, reward, and what its investors want. So the next time you read that your favorite company is doing a huge share buyback or taking on a massive new loan or even cutting its dividend, you'll know it's not just boring numbers on a spreadsheet. It's a signal. It's the company telling you a story. So the question is, what story are the companies you follow telling you with their financial choices?